Everyone will exit their business one way and another. The question is, how will you do it? So what's your strategic direction? Do you know which way you are going? I think this is one of the most important questions that everybody needs to answer. And it connects with the story of Alice and the Cheshire Cat. Alice says, would you please tell me which way I ought to go from here? The Cheshire Cat replies, that depends a good deal on where you want to get to. Alice replies, I don't much care where. The Cheshire Cat says, well, then it doesn't really matter which way you go. Now, I presume that everybody today has some idea of where they want to go. And so we will help you actually get there. So where are you going? Are you seeking to exit your business in the next 12 months, 3 years, 5 years, 10 years? Do you have an idea? And if you do, for your own benefit, please write that down. What's your target? Where are you going? Looking at British business statistics, survival rates of businesses that started in 2014 are a little depressing. Of those who started in 2014, only 42.5% of those survived through year 5. And of those 42.5%, 90% of them weren't saleable. 80% won't sell, and only 5% will sell for their target value. I think some of the 80% who wouldn't sell could sell, and even some of the 90% could be put into a position where they could sell. So wherever you are on this inverted triangle, we can help you get to your achieved target value. So exit planning. Sorry, I need to move this out of the way. So what should you do? The first question is timescale. How long have you got? I was talking to a client before Christmas, and he rang me up and he said, I want to sell in 6 months. That's a tall order unless you really are ready to sell. He also had a target value, and the question was the business actually worth that? So other people say, I want to do it in 3 years. Some, it's 5. What is your timescale? The sort of standard, typical process is something like this. It'll take about 3 years both to transform your business into its optimum state and to have the financial track record to support your sale. Can take longer. If you are further forward in that process, it might be shorter, but work on 3 years. It then takes about a year to find a buyer. Can take longer, but work on a year. And then it may take up to 3 years to do the to work through your exit agreement. It can be less. I think one of my cousins did it in 18 months, but the standard is 3 years. So that is effectively 7 years. Can be done less, but work on that as a good ready reckoner. There are opportunities and pitfalls. If you are ready to sell, your business is absolutely tip-top, and you know your number, then when that phone call comes and somebody says, I will give you 5, 10, 15, 20 or whatever million for your business, and you are ready to go, then you can sell in as little as 4 to 6 weeks. But you have to be ready. If you're not ready and you don't know, your accounting records aren't in the right space, your operations aren't in the right place, you will miss that. 50% of people will sell because they are distressed, they have disagreements with the management team, they suffer a disease or disability, divorce or death. If they were ready and prepared, they wouldn't have to take a discount, which is the risk if you are forced to sell. And that discount can be up to 60% of the value of your business. So if your business is worth $1 million and you have to sell it for 400,000, what does that do to your retirement? What does that do to your future lifestyle? How do you feel about it? So to avoid this outcome, Planning and having a plan is vitally important. So do you have a plan? Have you got any sort of plan? Some ideas in your mind, something you've written down in a notebook somewhere? Really important to have a plan, and the more detailed and professional it is, the better. First question, why are you selling? And second question, what will you do after you sell? And are these aligned? Significant number of business owners, it's been said 75%, though that may be a little high, actually regret selling the business a year later. So make sure that you're clear what you're going to do after you sell the business. So we have some exit options. You can sell outright. You can recapitalize and go again. Quite popular. You can liquidate if you really, really are fed up. Or you can change your role. I was speaking today with a client, and he had the prospect of there was an industry CEO who was being pushed out as a result of a VC takeover. And there was a question, well, if he wanted to come into the business, would you vacate the CEO's chair and go and be technical director, operations director instead, in order to grow the business? And he said, yes, of course. You can move up to be chairman. There was a company we did a management buyout with, and the main shareholder he was chairman, not man, he'd recruited a managing director to get the business ready for sale, and he was effectively CTO. Finally, you can transfer the business to your children, or you can do a management buyout, and employee benefit trusts are quite popular in this area. The important piece is to know what you're going to do next. Are you going to go and tour exotic locations? Are you going to go and do a road trip? What about buying a beach house and having time looking at the sunset, perhaps with family members to share it? Or even take up a new hobby. A friend of mine, his retirement, he's bought a couple of boats, yachts in the Caribbean, and he spends 4 months a year in the Caribbean, sailing the Caribbean, and a couple of months in the summer in the Mediterranean. Friends of mine have just come back from a lovely exotic location, and my brother-in-law is currently touring Australia. So being clear what you want to do is really important. The other thing is to align your exit with your reasons for retiring. Some fit more than others, and we're happy to talk you through what the options are. So question, how much money do you need? And is it how many millions, not how many hundreds of thousands? That is a question. So what is your number? Is there a shortfall between the number you want or need and what the business is worth today? And how long have you got to put it right? We have here a calculation. If you take your current income or the income you're going to need in retirement, which might need to be higher, and multiply that by 33, you get to 3.3 million in this example. If you take off assets and investments that you might have, whether they be property or shares or just cash in the bank, you come up with a net figure that you need, from which you have to deduct any long-term business debt and then the costs of actually selling the business. So there will be commission to a broker, perhaps. There will be legal fees. And of course, HMRC want to have their share. And there are discussions I've seen about the tax rates going up to 45%. So that is really a big change. So in total, you take those costs off the net proceeds needed, or in fact, in this case, add them, and you come up to the figure that you actually need to sell the business for. So you've gone through what you are going to do. You've decided on your exit route. You've worked out how much you need. The next question is the business actually worth it? And the standard method of valuing a business is to take your profit, to have a multiple, usually around 3.5, which then comes up with a valuation. And if you add some profit to the business over the time between now and when you wish to sell, that also adds to the value of the business. However, if you, instead of just adding some profit, seek to improve the multiple of your business, of that profit, to say 7.1, you come not at 2.8 million, but 5.7. And similarly, the 900,000 is multiplied by 7.1, which would take the business up to 6.4. A major, major difference, and in a current market, probably something everybody wants to achieve. So what is the process of sale? And beware of the pitfalls. There are different methods, and we can value all of them. EBITDA is the main one, but the other ones, particularly if you have a SaaS business, software as a service, then you may be selling on revenue. The other piece that's important is to understand what it is that your buyer is actually buying. Are they buying the whole business because they want a footprint in the UK market or a particular market? Have they got a business here already, and in reality they don't want the overheads, they just want the gross profit, sales and cost of sales? Or is it something that actually they've already got a operations team and they only really want your customers? So understanding that is important because it affects how we calculate what the business is worth. There are very important pitfalls. Finding a buyer is probably the first one, and it's not as easy as you think. Secondly, and probably an even bigger pitfall, is that your valuation and the buyer's valuation are a long way apart. I was looking at a business for a client recently. The seller wanted 11 million, and my client was struggling to get the valuation above 3. So if you want to sell, you need to be realistic on your valuation. You need to get an offer, which you like. There has to be due diligence from the seller, who will uncover anything that you haven't told them that they think they ought to know. And I've come across a deal recently which has failed to sell twice, and it's fallen down around the due diligence completion timescales. Finally, you've got to complete, and then the other issue to bear in mind is working capital. If a buyer has 10 million to buy your business, but your company needs 5 million of work in progress, of working capital, then there's 5 million less of the money that he has allocated to you to buying your business to pay you. So making sure that the company that you have, the business you have, throws off cash rather than consumes it is very important. Having got an offer, you'll get a percentage up front. It can be as low as 25%. It might be as high as 75%, depending on the business. The balance that is deferred will be paid out on an earn-out basis. There will be targets. There will be an earn-out period, which you have to fulfill. You will need to negotiate personal terms, especially if you've been used to just working all hours. You will need to work out how many hours a week you expected to work. You'll need to negotiate holidays, benefits, particularly if you've had, if the business has been a little bit of a piggy bank. And those are all important aspects. There are risks in the earn-out. When I sold my business a number of years ago, I discovered I struggled working with other people, not being in control. So working for somebody else, how will you feel about that? Can you achieve the earn-out targets? There are circumstances I've come across where buyers actually engineer a situation where you can't achieve the earn-out targets, which means they don't pay you the second figure, which means they get the business at a further discount. Not being in control can actually be an issue for many people. And you may have a situation connected with what I said earlier, where you are dependent on the buyer providing certain resources in order to achieve the earn-out targets. Is there a gap? If there is, how much is it and what can be done? Well, go back to your exit time planner. We have this period between 2023 and 2026 to put things right, to get things sorted out. And if we need an extra year or two, we can do that. So we close the gap. First of all, we look to improve the EBITDA multiple. And we do this because it is one of the key components in the valuation, and it gets your business more attractive to buyers. It gets it into a much better state to sell. And it will actually drive buyers to your business who will actually contact you and offer to buy it. So really important. People will know that you have a really, really well-run business. So just covering what these are. Financial performance. If your business is very profitable, it will be very attractive. If your business grows at a cantering rate, again, it will be very attractive, as long as the buyer can see that growth potential continuing into the future. Why you can see the tech giants in America, they buy often very early stage businesses for a few billion because they can see how that business and how its technology can enhance their own. The third piece here is how dependent is your business on a customer or supplier? None of these should be more than 15% of the total. And are you dependent on a particular employee? It's very important. And if so, you need to find ways to make sure that they are on board for the sale process and the sales journey. Working capital. I talked earlier about the importance of working capital, and this connects to debtors, creditors, and raw materials. And it's particularly connected around pricing and payment terms. If your business locks up a lot of money through the sales process, your business will be less valuable. So there's a conversation to be had around pricing and payment terms. There's a hierarchy of revenue. Some types of revenue are more attractive. Some types of revenue mean that there is more security for the buyer into the future. So is your revenue lumpy and one-off that you have to continue to hunt for new business every year? Is it regular services, finished goods, or a SaaS type revenue business? Each of these will have their own features and will have their own risks around valuation. Effectively, this is, do you set the price or do you have to take somebody else's? So if you sell bog standard products, then there's probably a market price that you have to meet, and you haven't got much of an ability to put prices up. If you have mid-range products and services, you probably have more freedom, and the higher end, even more freedom. And if you're a monopoly supplier, you can charge what you like. Again, the monopoly supplier will be much more attractive and profitable. Customer satisfaction, something that's often neglected in businesses. What is your customer satisfaction score? Customer satisfaction connects to retention, customer retention, and the ability of them to buy more cross-selling products and buying more from you, and recommending you to other people, which means growth is easier. This is about owner dependency. If you were to go away for 3 months, would your business still exist when you came back? Would it be in a better shape? Does your team know what to do when you're not around? Many of the businesses that aren't saleable because they're too dependent on the owner. That can be resolved and sorted out, but it needs work. So we've talked about how we close the gap using EBITDA multiples. Now we move on to how we close the gap using business growth drivers. And this is aimed not at improving the EBITDA multiple, but improving the profit in the business, which the EBITDA multiple is multiplied by. So we have a series of business drivers. The first is acquisition of customers. This is connected to your marketing and sales operations. Then you have retention. The more people who you do business with that you retain and do business again, they are much easier to do business with and much cheaper because you don't have to spend all the money on the marketing and sales in order to attract them. The gross margin is effectively your cost control on your cost of sales. Frequency, how often do people buy from you? Is there an ability for you to sell your product to them every year, as you might do with an accountancy firm or an insurance firm or a financial planning practice? Can you cross-sell? Are you like Amazon, who started with books and then has worked their way into other services, other products? Transactional value. This comes down to your sales pricing. Why do you sell at the price you sell? What flexibility do you have to be able to sell at a higher price? And finally, overheads. How do you minimize the cost of your overheads but get the right value that you need? We now move on to working capital. There are three key drivers in working capital: creditor days, debtor days, and what's called stock and work in progress turn. I'm going to focus on debtors because that's the most significant and the most easy to deal with, but it's most illustrative. So we have here a company. Alex has a software business. She has a million turnover. She has cost of sales and some overheads. And you can see here that the gross profit has gone up by 1%, which means that work's been done on keeping the cost of sales costs down and the overheads cost as well. And this means that the net profit percentage has gone up by 2%, and the net profit itself has gone up by 30%. So you can see the benefit here of small changes to cost of sales or and overheads as a percentage of sales. And if you also do work on the sales line as well, then you can see how there is a process by which you can raise the profit significantly. The other piece we're looking at is cash flow. We're going to look at debtor days. And you can see in this example that the debtor days are 72. They're up from 69, and the creditor days are down from 31 to 27. And the impact this has is to create the 53,000 overdraft at the end of the year. If, however, you reduce the debtor days to 40, then the overdraft disappears and becomes cash in the bank. And the swing is £87,000. And that means that you have more cash to invest in the business and invest in its growth. And if you took some of that growth and then applied it to growing the business and you increase the revenue by 50%, you can see that if you don't reduce your debtor days, your overdraft actually goes up, notwithstanding the fact that your sales are up. And that's because of the length of the debtor days. If, however, the debtor days are reduced to 40, then the benefit of the increased turnover turns up in the bank account, and you have a swing of £106,000 worth having. And you can see how you can then finance your growth through internal resources rather than having to go cap in hand to a bank or an investor to do so. So what's your plan? You must have a plan. It's really, really important. Too much financial information is looking backwards, and you can't drive looking backwards. You drive looking forwards, and you need a plan. Like driving, you need a sat-nav to get to your destination. And the advantage of the sat-nav illustration is that if you end up taking a wrong turn somewhere, the sat-nav will tell you how to get back on track. And that's what we aim to do. So we start with a profit and loss cash flow balance sheet forecast. And we build, based on your sales, cost of sales, and overhead assumptions, a scenario to create your profit and loss account for the next 5 years. It's high level, but it's valuable. We understand your cash flow projections, and we establish your projected balance sheet, which means that we know that everything adds up. And this provides a route map for you to get from where you are today to your exit that you want. And we have here a summary, and you can see how we have this high level sales, cost of sales, gross margin, overheads, and net profit, together with some supportive information. Having got that, you cannot sit back and relax and think it's all going to work out. You have to, are we nearly there yet? Usually we aren't. So we have to review progress against plan on a regular basis, preferably monthly, absolutely minimum quarterly. And it provides the basis for getting back on track when things go a bit awry. And every one of you will know that in business, things don't always turn out the way you expect. So, important piece here is keeping your eye on the road. Same way when driving. Review your business plan on a regular basis and ensure that you can identify the reasons for variances in performance across the main profit, loss, and working capital KPIs. And we have reports that provide this information so that you can keep on track, get back on track when you've gone off track. And this one here is keeping the prize on the valuation. So if you need, this illustration is if you target is 400,000 and the current performance is indicating that it'll be year 6, not year 3. And the important piece here is taking action now to get the valuation back on track. So we've had a bit of a whistle-stop tour. So I've covered understanding your timescale to sell, knowing your number and being ready to sell, understand your reasons to sell and what to do next, knowing how much money you need, understand how much your business is worth today, planning how to improve the EBITDA multiples, and planning how to improve profit and cash flow. Both of these will increase the valuation of your business. The importance of financial planning for the next 3 years, and together with monitoring performance to keep on track. And if you do all of these things and perhaps work with us, then you will achieve your goal of a high value exit. So, in conclusion, are you exit ready today? Do you have an exit plan in place? And if not, then we'd love to help you. And I'm offering a Zoom call, 2-hour Zoom call, to work with you to prepare your high-level 5-year plan based on your current financial information. We will target your route to achieve the exit value you want to achieve your desired retirement lifestyle.